Have you ever wondered what invisible force actually holds the global economy together?
Mm,
I mean, it's not trade agreements.
right.
It's not gravity. It is a single floating unit of account, the U.S. dollar.
And we interact with it every single day, right? Handing over cash or swiping a card. Yet the sheer scale of what it does on a planetary level is almost entirely hidden from view.
Yeah, it operates like the world's underlying operating system.
Exactly.
And if you've been anywhere near financial news or YouTube social media lately, you've seen the incredibly loud, dramatic headlines.
Oh, they're everywhere.
The ones screaming about the death of the dollar or the
Ever.
imminent collapse of the American economic empire.
Right.
It feels like every other day there's a new prediction that the sky is falling and a brand new global currency is going to just wipe out our life savings overnight.
Those narratives are, well, they're incredibly potent because they tap directly into our anxieties about a rapidly changing world order. I mean, fear sells.
It definitely sells.
Yeah. But when you bypass the clickbait and actually look under the hood at the plumbing of international finance, the reality is far more nuanced. Frankly, it's a lot more fascinating than the apocalyptic stuff.
And that's our mission for this deep dive. We're cutting straight through the noise. We're going to decode the precise, invisible architecture of global wealth.
Yeah.
We're exploring how geopolitical fragmentation is reshaping money in real time. And most importantly, we're going to define exactly what this means for you, the listener, as you navigate your investments, your career, and your daily life in an evolving world order.
A great place to start is just setting the baseline expectation.
Okay.
The future we're heading toward isn't about a sudden, catastrophic replacement of the dollar. You aren't going to wake up next Tuesday to find that a new currency has magically taken over global trade.
Rendering the dollars in your bank account worthless.
Exactly. What we're actually living through is a subtle, highly complex, and gradual adjustment in how global liquidity is organized.
It's a structural evolution, not a Michael Bay explosion. And to really grasp where the system is going, we first have to understand the mechanics of how we got here. We have to look at the invisible architecture that allowed the dollar to conquer the world in the first place.
It's a fascinating history.
Because the origin story of the modern financial system really traces back to a very specific moment, the aftermath of World War II and the Bretton Woods Conference.
Picture the geopolitical landscape in 1944.
It was bleak.
Completely. The global economy was utterly devastated by years of total war. European infrastructure was in ruins. Trade networks were completely shattered.
Yeah.
There was an existential, urgent need to establish a brand new, stable framework to rebuild international trade and finance from the ground up. So, delegates from 44 nations gathered at a hotel in New Hampshire to hammer out a new reality.
And what they built placed the U.S. dollar squarely at the center of the global monetary system. But there was a massive caveat compared to today's money.
A huge one.
At the time of Bretton Woods, the dollar was backed by physical gold.
Right, it was a fixed system.
Other global currencies pegged their value to the dollar, and the dollar was pegged to gold at a fixed price of $35 an ounce. The U.S. essentially promised the world that its paper money was just a convenient proxy for the massive piles of gold sitting in Fort Knox.
And that physical tether provided the ultimate psychological and economic stability. There was a hard asset backing the paper.
It was tangible.
Exactly. It gave the rest of the world the absolute confidence needed to use the dollar to rebuild their shattered economies. It was an institutional foundation deliberately designed to prevent the chaotic, competitive currency devaluations that had absolutely devastated the global economy during the Great Depression in the 1930s.
And it worked brilliantly for a few decades. It fueled the massive post-war economic boom. But then we hit the plot twist.
Here we go.
Fast forward to the late 1960s and early 1970s. The U.S. is spending massively on domestic programs and the Vietnam War. Inflation is rising.
Right, the math starts breaking down.
Foreign nations, particularly France, start getting nervous and actually begin demanding actual gold in exchange for their paper dollars.
Yeah, French President Charles de Gaulle even sent a battleship to New York to repatriate French gold.
A literal battleship.
A literal battleship. The system was breaking under the strain of a classic bank run. The U.S. simply didn't have enough gold to cover all the dollars printing and circulating globally.
So that forces the event known as the Nixon shock in 1971. The United States unilaterally suspends the dollar's convertibility into gold. They just cut the cord entirely.
Unilaterally. without warning the rest of the world.
Now, pose this to anyone on the street. You'd think removing the physical gold backing, the very thing that supposedly gave the paper its value, would destroy the currency.
You would assume that.
You'd assume the entire global financial system would just collapse overnight in a massive crisis of confidence.
It's one of the great counterintuitive moments in economic history. Removing the gold backing should have logically shattered international trust. Instead, it did the exact opposite.
It hypercharged the dollar's dominance.
It completely hypercharged it.
Let's unpack the mechanics of that, because this is where the modern world is truly born. How does removing the underlying asset make the paper more powerful?
By severing the tie to physical metal, you completely remove the physical constraints on the expansion of money.
Okay.
Under a gold standard, the amount of money in the system is ultimately limited by how much gold you can pull out of the ground and store in a vault. By shifting to a floating exchange rate regime, where currencies trade based on market confidence and economic output, it allowed global capital markets to expand dramatically.
So it scaled.
Radically. The dollar transformed from a tethered proxy for a shiny rock into a pure, unconstrained instrument of global liquidity.
It went from being a boat tied to a dock to a nuclear submarine that could go anywhere and scale infinitely.
I love that analogy.
Which brings us to the actual structure keeping it dominant today. It isn't just historical momentum from 1971. There are massive, concrete structural advantages.
Very concrete.
Let's break down the three pillars of modern dollar dominance, starting with Pillar 1, unparalleled market depth. We're talking about the U.S. Treasury market.
The Treasury market is the absolute bedrock of the entire global financial system. When the U.S. government runs a deficit, it issues Treasury bonds. These bonds represent the largest, most liquid pool of what the financial world calls safe assets.
Now, that term safe asset sounds comforting, but in high finance, it has a very specific mathematical and functional meaning.
It does.
If I'm a global investor managing sovereign wealth, what exactly makes a Treasury bond safe?
Safety in this context means two things: absolute confidence that the asset will retain its value, and the ability to sell it immediately at any second under any market conditions without destroying the price.
Right.
Think about the players in this arena. We aren't talking about day traders on an app. We're talking about sovereign governments, central banks, massive pension funds, and multinational corporations.
The whales.
The biggest whales imaginable. If a foreign central bank is sitting on $500 billion in foreign exchange reserves, they can't just leave that in a commercial bank account.
No, the insurance limits on commercial accounts wouldn't even cover a fraction of a percent of that.
Exactly.
And they certainly aren't going to dump $500 billion into the stock market. If there's a 20% market correction, a massive chunk of their nation's wealth just evaporates.
Which is an unacceptable risk for sovereign wealth. You need a massive vault to park that wealth where it earns a modest, reliable return, but more importantly, where it is incredibly secure and instantly accessible.
And that's the Treasury market.
The U.S. Treasury market is currently a $26 trillion ocean. It is the only pool in the world large enough and deep enough to absorb those enormous volumes of capital without overflowing. If a massive institution needs to liquidate $10 billion on a random Tuesday morning to cover an emergency, they can do it in the Treasury market in seconds, and the market won't even blink. No other financial market on Earth offers that combination of gargantuan scale and immediate, frictionless liquidity.
So Pillar 1 is the ultimate, infinitely deep, safe deposit box for the world's savings. Now, on to Pillar 2, global trade pricing. This is the pillar that directly touches everyone's life on a daily basis.
It's the structural reality that the fundamental raw materials of modern civilization are routinely priced and settled in U.S. dollars.
We're talking about energy markets, industrial metals, agricultural products.
Yes. When a country buys oil, they are almost always looking at a dollar price tag and paying in dollars, regardless of where the oil was pumped or who is buying it.
It's the universal translator for global commerce.
It really is.
If a Japanese electronics manufacturer wants to buy raw copy from a mine in Chile, they aren't trying to figure out the complex, daily fluctuating exchange rate between the Japanese yen and the Chilean peso.
No, that introduces massive exchange rate risk that could wipe out their profit margin by the time the ship arrives.
Exactly. They both just look at the global dollar price of copper and settle the transaction in dollars.
And removing that friction is what allowed modern globalized trade to flourish, but it also creates a massive, constant, structural demand for the U.S. dollar that has absolutely nothing to do with the U.S. domestic economy.
Right, because if a nation needs to buy energy or food to keep its citizens alive, it must acquire U.S. dollars first.
Which sets up Pillar 3 perfectly, the global banking ecosystem. Because if you're a country that doesn't use dollars domestically, but you absolutely need them to buy oil, how do you get them?
You have to borrow them.
You have to borrow them. And that necessity creates a vast, interconnected financial ecosystem. Financial institutions outside the United States are constantly borrowing and lending in dollars. It's an incredibly integrated web.
How does that look in practice?
Well, a bank based in Europe might issue a massive dollar-denominated loan to an infrastructure company in South America to build a dam. The entire transaction, from start to finish, happens completely outside the United States between non-U.S. entities, but it relies entirely on their access to dollar liquidity.
Okay, so we have this immense three-part architecture. The deepest safe asset pool in the treasury market, the default pricing currency for the world's vital commodities, and a massive global banking system wired to run on dollar credit.
That's the foundation.
Let's ground this vast architecture for a moment. This can all sound like abstract, high-level economic theory, but when you go to the supermarket to buy groceries or fill up your car or check your retirement account, you are actively participating in this exact dollar-denominated ecosystem.
The connection is direct. The cost of the gas you put in your car is heavily influenced by the fact that crude oil is priced in dollars globally.
Right.
The consumer goods on the shelves at your local store likely arrived on container ships that paid their global transit fees, port taxes, and maritime insurance in U.S. dollars. It's everywhere.
And your retirement fund is almost certainly holding U.S. treasuries as its foundation of stability, while also investing in multinational companies whose entire revenue models and supply chains depend on the smooth, uninterrupted functioning of global dollar credit.
It's the invisible water we're all swimming in. The dollar's relative strength or weakness, and its availability globally, trickles all the way down to the price of a gallon of milk.
Exactly.
Let's zoom out for a second. Because while the U.S. Treasury prints the physical bills and the Federal Reserve manages the domestic supply, the global use of the dollar has taken on a wild life of its own. We have to explore what is essentially a phantom network operating in the shadows of global finance.
Phantom network captures the reality perfectly. Most people assume that every single U.S. dollar in existence is somehow directly tracked, controlled, or accounted for by the Federal Reserve down in Washington, D.C.
Right, there's a master ledger somewhere.
But that is fundamentally false. We have to look at the mechanics of the eurodollar market. Let's clear up the terminology right away, because eurodollar is a terrible, confusing name. It actually has absolutely nothing to do with the modern euro currency used by the European Union, right?
Nothing whatsoever. The term eurodollar simply refers to any U.S. dollar-denominated deposit held in a bank located outside the United States.
Got it.
And the origin story of this market is fascinating because it was born out of Cold War paranoia.
This is one of my favorite historical quirks. In the 1950s, the Soviet Union was earning U.S. dollars from selling their oil and commodities. But they were terrified of keeping those dollars in banks located in New York.
Right, because they thought the U.S. government might freeze or seize their assets if the Cold War turned hot.
So to protect their funds while still holding the world's most useful currency, the Soviets decided to deposit their U.S. dollars in a Soviet-owned bank located in London called the Moscow and Narodny Bank.
Brilliant workaround. Because the bank was physically outside the U.S., it was outside the direct jurisdiction and regulatory reach of the Federal Reserve. They created the first offshore dollars.
Hence the euro prefix, since it started in Europe.
Exactly. But today, a eurodollar applies to an offshore dollar deposit in Tokyo, Singapore, Dubai, or anywhere else outside the U.S. regulatory umbrella.
Okay, so a eurodollar is just an American dollar sitting on a ledger in a foreign bank. Why does a ledger entry outside the U.S. matter so much to the global economy?
Because it allows banks worldwide to effectively create dollar-denominated credit out of thin air through fractional reserve lending.
That is a massive conceptual leap.
It is. Let's walk through the mechanics.
Walk us through it.
Say a commercial bank in London takes in a $1 million eurodollar deposit. Because they aren't bound by U.S. domestic banking reserve requirements, they can take that deposit and lend it out to a mining company in Brazil.
And the Brazilian company takes that $1 million loan and uses it to pay a heavy machinery supplier in India. The Indian supplier then takes that payment and deposits it into their local bank in Mumbai.
Right. And then that Indian bank looks at the $1 million deposit and says, great, we have new reserves. And they lend a portion of it out again to another company.
And this process cascades globally.
Precisely. These foreign banks are essentially multiplying the amount of functional dollars circulating in the global economy, creating a massive pyramid of dollar credit, all without the U.S. Federal Reserve ever being involved in the transactions.
They are acting as shadow central banks.
Exactly.
This massive network of offshore, unregulated lending transformed the dollar from being just a national currency used to buy things inside America into the ultimate global liquidity instrument. The eurodollar market is the actual hidden plumbing that finances global trade. It's estimated to be tens of trillions of dollars in size.
And no one actually knows the exact number because it's a decentralized network of ledgers.
And what poured absolute gasoline on this phantom network was the supply chain boom of the late 20th and early 21st centuries. Hyperglobalization accelerated this offshore dollar dynamic to a scale previously unimaginable.
Let's map out a modern supply chain to make the math of this concrete. Think about how a smartphone is made today.
Okay.
You have raw cobalt being mined in the Democratic Republic of Congo. That raw material is shipped to a specialized processing facility in Southeast Asia. Those processed components are then shipped to massive assembly plants in China.
The software of architecture is designed in the United States.
Right. And finally, the finished phone is shipped to a retail store in Europe. That's a single product's journey spanning 4 continents, involving at least 5 completely different sovereign currencies.
The friction of managing that without a universal currency would be catastrophic.
Unimaginable. Imagine the absolute operational chaos if every single step of that supply chain had to constantly negotiate and hedge exchange rates in real time.
Yeah.
The Congolese miner wants to be paid in francs, but the Asian processor only holds their local currency. If the exchange rate between those 2 specific currencies shifts by 5% while the cargo ship is on the ocean, the entire profit margin for the manufacturer is wiped out.
The sheer risk and complexity would make building the smartphone economically unviable. They desperately need one single, stable, universally recognized currency for invoicing and settlement across every single border.
And the dollar was the only logical choice because of that $26 trillion treasury market depth we talked about and the massive eurodollar banking network ready to provide the credit. It was the only currency with enough global liquidity to grease the wheels of a multi-continent manufacturing chain.
Once an industry adopts a standard like that, you trigger what economists call path dependence, which is driven by powerful network effects. The easiest analogy is the QWERTY keyboard on your computer or phone.
I love the QWERTY analogy.
Is QWERTY the most efficient layout for typing? No, it was originally designed to slow typists down so mechanical typewriter keys wouldn't jam. But why do we still use it today? Because every keyboard is built that way, and everyone already knows how to use it.
Even if someone invents a far superior, faster keyboard layout tomorrow, the friction of retraining a billion people and replacing billions of physical keyboards makes switching practically impossible.
Right.
Global finance operates on the exact same principle. Once a critical mass of international trade is priced in dollars, a massive infrastructure hardens around it. All the enterprise accounting software, the complex legal contracts, the corporate treasury risk models, the corresponding banking relationships, they are all painstakingly built and optimized specifically for dollar settlement.
You cannot just decide on a Tuesday afternoon to start invoicing a complex multinational automotive supply chain in a brand new currency.
No. The operational friction, the legal rewriting, and the new financial risks are simply too high.
So the dollar becomes entrenched through sheer operational convenience and those compounding network effects. But this leads to a fascinating and deeply asymmetric dynamic. Because the entire world relies on this dollar credit to function, the U.S. Federal Reserve effectively operates as the central bank for the entire planet, even though their legal mandate only covers the domestic United States.
It's an immense structural power, and it often creates massive unintended global consequences. U.S. monetary policy effectively dictates global financial conditions.
How does that play out?
Well, when the Federal Reserve decides to raise interest rates to cool down domestic inflation, say, because the housing market in America is running too hot, they are tightening policy. But because the phantom euro-dollar network means the whole world borrows in dollars, the Fed is simultaneously raising the cost of capital for everyone else on the planet.
It's incredible to think about. The Fed chairman sits in an office in Washington, D.C., looks at job reports from Ohio and Texas, decides to hike rates by 0.5%, and instantly, a real estate developer in Indonesia finds out their floating rate corporate loan just got massively more expensive to service.
Exactly. The availability and cost of dollar credit dictates the economic heartbeat of the world. It violently drives emerging market cycles. When the Fed keeps interest rates near zero, dollars are cheap and plentiful. Investors hunt for yield, so capital flows heavily into emerging economies, funding infrastructure, tech startups, and rapid growth.
But the moment the Fed tightens and dollars become scarce and expensive.
That capital brutally reverses course. It flees back to the perceived safety of the U.S., often triggering massive currency depreciations and severe economic distress in those emerging markets left behind. It even impacts the price of raw materials. A stronger dollar generally pushes down global commodity prices, hurting export nations.
It's a breathtaking amount of centralized influence over an increasingly decentralized, globalized world. But the real story is, the world isn't staying static.
No, it is not.
The geopolitical temperature of the planet is changing, and it is changing rapidly. The era of assuming a rising tide of global integration will last forever is over. Let's shift our focus to the past decade and the intense era of fragmentation.
The past 10 years have delivered a profound wake-up call to the global system. The period of hyperglobalization, the 1990s and 2000s, where everyone operated under the illusion that we were marching toward one seamlessly integrated, frictionless global market, is effectively dead.
Yeah.
We have decisively entered a new era characterized by sharp strategic competition between major world powers.
We see the evidence every time we look at the news. Massive trade disputes, sweeping tariffs, intense restrictions on technology transfers. Countries are actively pulling up the drawbridges.
They are trying to secure their own independent supply chains, hoarding critical minerals, subsidizing domestic semiconductor manufacturing.
And sitting right in the crosshairs of this rising geopolitical tension is the global financial system itself.
Understanding this requires us to take a highly objective, neutral look at how the system's architecture is being utilized today. One of the most significant and disruptive developments in modern statecraft has been the expansive use of financial sanctions. By leveraging the reality that global finance must eventually flow through dollar-based channels, the financial plumbing itself has been weaponized.
Let's break down the actual mechanics of that weaponization, purely structurally. How exactly does a financial sanction execute its power in a dollar-dominated world?
It goes back to the pillars we established earlier, the massive clearing systems, the global banking networks, and specifically the SWIFT messaging system.
SWIFT is crucial to understand.
Yes, it isn't a bank, it doesn't hold money. It's basically the highly secure financial equivalent of WhatsApp that banks use to send payment instructions to each other globally. But because so much trade is in dollars, the vast majority of these messages eventually require settling funds through what are called correspondent banking accounts held at major U.S. banks.
Meaning, if a bank in Asia wants to send $1 billion to a bank in South America, the actual ledger adjustment often happens on the servers of a massive bank in New York.
Precisely. To move large volumes of capital internationally, the money almost inevitably has to touch a U.S. jurisdiction or interact with a U.S.-regulated financial entity. If political authorities decide to sanction a specific corporation, an oligarch, or an entire sovereign nation, they can legally block them from accessing those correspondent accounts.
They're effectively cutting the wire on their financial oxygen. The target can't settle international trade. They can't pay for imports. They can't receive money for their exports. And crucially, they can't access their own foreign exchange reserves if those reserves are held in digital form at foreign banks. They are completely exiled from the global economy's operating system.
The watershed moment for this, structurally speaking, occurred in early 2022 with the sanctions applied to Russia. We're looking at this purely from a mechanical perspective.
Right.
Overnight, roughly $300 billion of the Russian central bank's sovereign reserves, money they believed was their own, accumulated through years of energy sales, was frozen by Western governments.
Regardless of the political or moral justifications for that specific action, the mechanism itself set a terrifying shockwave through the rest of the world. It crossed a fundamental Rubicon. Countries across the global south, many of whom are heavily reliant on dollar channels, suddenly looked at the architecture of the system and realized their own extreme vulnerability.
It shattered an illusion. They realized that their sovereign reserves, the national savings meant to protect their currency in a crisis, weren't actually money in the bank.
What were they?
They were essentially permission slips granted by the nation that controls the financial infrastructure. If your entire economic lifeblood is dependent on a network that can be turned off by another capital with the flip of a switch, you do not possess true economic sovereignty.
That is a profound, paradigm-shifting realization,
Yeah.
and it completely rewires the geopolitical calculation. Reducing reliance on the US dollar is no longer just an abstract economic theory debated by academics. For many sovereign nations, developing financial independence has become an urgent matter of vital national security.
It's fundamentally a defensive maneuver. If you recognize a vulnerability that could collapse your economy, you are obligated to mitigate it. So the drive for monetary independence is rapidly accelerating. We are witnessing the active, intentional rise of regional economic blocs.
And it isn't just political posturing anymore. We are seeing active, concrete steps being taken to build alternative plumbing. Let's look at what this looks like on the ground. How does a nation actually start untangling itself from a network as pervasive as the dollar?
You can't do it overnight, so you start small and you start bilaterally. We're seeing a significant surge in bilateral trade agreements where two nations agree to settle their specific cross-border trade using their own local currencies.
Give us an example.
For example, if country A is a major exporter of oil to country B and country B exports manufactured solar panels to country A, they attempt to net out the value of that trade in their respective currencies, bypassing the need to acquire and use dollars for that specific closed loop.
It's essentially high-tech bartering at a national scale, using local fiat money instead of a neutral third-party currency.
Exactly. But beyond just bilateral deals, we are seeing the engineering of entirely new parallel payment systems, systems like China's CIPS, the cross-border interbank payment system, or experimental digital ledger projects like mBridge.
What's their goal?
The explicit goal of these projects is to design financial networks specifically built to bypass the traditional dollar-based routing and SWIFT messaging entirely. They are trying to lay down parallel pipes for capital to flow across borders without ever touching a U.S. server or requiring a U.S. correspondent bank.
Put yourself in their shoes for a moment. If you were a foreign central banker and you just watched global finance be deployed as a highly effective strategic weapon, wouldn't you immediately start building your own backup generator?
You would have to.
Even if you recognize that you still have to use the main dollar power grid 95% of the time to survive today, wouldn't you want to know you had a functional generator in the basement, just in case your connection to the grid was severed?
It is an entirely rational, predictable response to a shifting geopolitical environment. The immense friction between global powers is naturally encouraging the development of distinct parallel economic ecosystems. The multi-decade era of relying on a single, undisputed, universally trusted financial network is visibly fracturing.
So we have all these ingredients in the pot. We have rising geopolitical tensions, we have massive global powers actively trying to build alternative financial systems, and we have those endless headlines screaming that the death of the dollar is upon us. It sounds like the transition is imminent and unavoidable. Now here's where it gets interesting, because we have to introduce a massive dose of reality. This brings us to the illusion of de-dollarization.
Ah, yes.
There's a wildly popular narrative circulating that the dollars can be replaced tomorrow, and that these new payment rails and local currency agreements mean the dollar's days as the global reserve are strictly numbered.
That narrative is fundamentally flawed because it deeply misunderstands the heavy machinery of global finance. It is monumentally difficult to replace the dollar. The barrier to entry is staggering, and it circles back to the exact reasons it became dominant in the first place. Currently, no other single country or economic bloc on Earth offers the necessary trifecta of conditions required to host a true global reserve currency.
The trifecta. This is the ultimate stress test for any proposed alternative. Let's define these three crucial requirements in detail, because this is where all the theories about the BRICS nations or the yuan taking over usually fall completely apart. Requirement number one, massive market liquidity.
We touched on this with the $26 trillion Treasury market. A global reserve currency isn't just about trade, it's a storage mechanism. It must be able to securely absorb trillions upon trillions of dollars of excess global savings.
Right.
If you are a rising economic power trying to push your currency as the new alternative, but your domestic government bond market is relatively small, or it's heavily restricted to foreign buyers, or it's illiquid, foreign investors simply cannot park their national wealth there.
It just won't fit.
Exactly. If a central bank tries to dump $500 billion into a small bond market, they will instantly distort the interest rates and shatter the system. You need an ocean to hold the world's wealth. Almost every alternative currency currently proposed only offers a swimming pool.
You cannot dock a massive supertanker in a shallow local marina. The U.S. financial market is the Mariana Trench of liquidity. Okay, requirement number 2, robust legal infrastructure.
This point is frequently ignored in the debate, but it is absolutely critical for institutional capital. Investors require absolute ironclad confidence in property rights, transparent bankruptcy laws, and a fierce, independent judiciary.
Why is that so crucial for a reserve currency?
If a complex dispute arises over a multi-billion-dollar international transaction, you need the absolute certainty that it will be resolved fairly in a court of law based on established precedent, not resolved by arbitrary political decree from a ruling party. The predictable, boring reliability of the legal framework is just as vital as the nation's GDP growth.
If there's even a fractional risk that a foreign government could simply seize your assets or change the rules of ownership overnight because they changed their political mind, you are not going to leave your nation's sovereign reserves in that jurisdiction. And that ties directly into requirement number 3, which is the hardest to manufacture. Deep institutional credibility and open capital accounts.
Institutional credibility is a fragile thing. It takes decades of consistent behavior to build, and it can be destroyed in seconds. It means maintaining an independent central bank that makes difficult monetary decisions based on economic reality, not short-term political pressure from the executive branch.
Right.
More importantly, it requires a historical track record of open capital accounts. This is the killer for many alternatives. An open capital account means you can move your money into the country, and crucially, move your money out of the country freely at any time without facing government capital controls trapping your funds.
Let's use a real-world example here. China is clearly the largest economic challenger to the U.S. and actively promotes the internationalization of the yuan, but they operate with strict capital controls. Why does a country implement capital controls, and why does that immediately disqualify them from being the global reserve?
Countries use capital controls to manage their exchange rate and prevent capital flight during times of domestic economic stress. They want to ensure wealth stays inside the country to support the local economy. But the moment you restrict the flow of capital out of the country, you create what I call the Hotel California problem for international investors.
You can check out anytime you like, but you can never leave.
Exactly. You can check your money in, but you can never leave. If a global investor or a central bank fears they won't be able to withdraw their billions during a panic because the host government suddenly locked the exit doors to protect their own currency, they will never park their money there in the first place. You cannot be the global reserve currency if you trap foreign capital inside your borders.
To truly replace the dollar, an alternative has to offer all 3 things simultaneously: a massive, highly liquid bond market to store wealth, an unshakable, transparent legal system to protect wealth, and total institutional credibility with no capital controls so you can access your wealth. And when you scan the globe right now, well, the euro has the legal structure but a fragmented bond market. China has the economic size but lacks the legal transparency and open capital accounts.
Yeah.
No alternative currently exists that checks all 3 boxes at the scale required.
None. There is a massive void where an alternative should be. And even if a perfectly engineered alternative did magically materialize tomorrow, we run straight back into the sticky web of network effects we discuss with the QWERTY keyboard.
Path dependence strikes again. Let's detail the brutal friction involved here. Even if a viable alternative existed, why wouldn't a multinational business or a massive global bank just make the switch?
Because the immediate financial costs and the sheer operational nightmares are prohibitive. Think about the internal architecture of a massive global bank. Their highly calibrated risk management algorithms, their complex compliance and anti-money laundering software, their daily treasury operations, their thousands of bilateral corresponding banking relationships spanning the globe. Every single line of code and legal contract is fundamentally optimized for dollar settlement.
So to pivot away from the dollar requires rebuilding your entire financial infrastructure from the ground up.
It requires taking on massive new layers of unpredictable exchange rate risk. Unless there is an overwhelming immediate economic incentive to switch, like a massive discount on goods that offsets the cost of restructuring, the default corporate action is always to remain within the established liquid system. The friction of change acts as a gravitational force keeping the dollar anchored.
So if the dollar isn't actually being replaced, what exactly are we witnessing with all these headlines? What are these countries actually doing? We have to clearly define the difference between diversification and replacement.
Framing it as diversification is exactly right. The global system is actively diversifying. It is absolutely not de-dollarizing in the sense of a complete replacement. Central banks around the world, particularly in emerging markets, are deliberately adding other assets to their reserve portfolios. We are seeing record purchases of physical gold by central banks. And as we detailed, specific targeted trade corridors are shifting to local currency settlements to bypass potential sanctions.
They are acting like prudent portfolio managers. They realize holding 100% of their wealth in a system controlled by a rival is a bad idea, so they are hedging their bets. They're spreading the risk around.
Exactly, they're building a buffer. But when you zoom out and look at the aggregate global data, the actual volume of foreign exchange transactions, the composition of global debt, the invoicing of global trade, the US dollar still represents the overwhelming lion's share. It still utterly dominates the plumbing of international funding markets. The slice of the pie belonging to alternative currencies is undeniably growing, but the dollar slice remains staggeringly massive.
Now here's where it gets interesting. Because you would logically assume that with all this intense geopolitical effort to diversify and all the anxiety about weaponized finance, the very next time a massive global crisis hits, the world would finally seize the opportunity to pivot away from the dollar.
Right, a crisis is usually the catalyst for systemic change. You'd expect a massive shock to be the moment the new alternative systems finally take over and prove their worth.
But let's look at the actual battlefield of foreign exchange and global volatility. Let's look at what historically happens when the alarm bells actually ring and the financial house catches on fire.
It creates what I call the ultimate panic room dynamic. And it highlights perhaps the most incredibly ironic reality regarding the modern global financial system. When the global market experiences a sudden severe shock, whether it's a global pandemic lockdown like in March 2020, a massive banking contagion, or an unexpected geopolitical war, where does all the capital in the world instantly run?
It runs straight back into the arms of the US dollar. It is the ultimate undisputed flight to safety.
The global demand for dollar liquidity doesn't drop during a systemic crisis. It skyrockets exponentially. Because in a moment of extreme fear and uncertainty, institutional investors and central banks do not want complex, untested alternative payment systems. They do not want illiquid local currencies that might devalue overnight. They want the absolute deepest, safest asset pool on planet Earth.
So they sell everything else.
They violently sell off whatever risky assets they hold, equities, emerging market bonds, foreign real estate, and they frantically buy US dollars and treasury bonds to protect their capital.
It's a global stampede for the exits, and the only door out is shaped like a dollar sign. But this creates a massive mechanical problem. If everyone in the world suddenly demands physical dollars at the exact same millisecond, the entire system could seize up like an engine with no oil. That phantom network of eurodollars we talked about, the one built on fractional reserve lending, could spectacularly collapse if there isn't enough actual underlying liquidity to meet the panic-driven withdrawal demand.
And this is the precise moment where the architecture reveals its true hidden backstop mechanism. During these periods of extreme global stress, the U.S. Federal Reserve is forced to step in not just to save the U.S. economy, but to act as the lender of last resort for the entire globe. They have to inject massive amounts of liquidity into the phantom network to prevent a total collapse. And they execute this by activating emergency mechanisms called swap lines.
Swap lines. These rarely make the evening news, but they are the hidden safety nets holding the world together.
Yeah.
Let's break this mechanism down simply, step by step, because it perfectly illustrates who really holds the power. How does a swap line actually function during a crisis?
Imagine it's March 2020. The global economy is shutting down. A massive commercial bank in Europe desperately needs $1 billion immediately to fund its daily operations and pay its dollar-denominated debts. But the private lending markets have completely frozen out of fear. No other bank is willing to lend.
So what happens?
The European Central Bank, the ECB, wants to help, but they only print euros. They cannot print US dollars. So the president of the European Central Bank picks up the phone and calls the chairman of the US Federal Reserve. The Fed agrees to open a swap line. They essentially agree to swap freshly created US dollars for euros at a fixed, predetermined exchange rate for a specific period of time.
So the Fed types some numbers into a computer, creates $1 billion out of thin air, and pumps it directly into the European Central Bank's account. In exchange, the Fed holds $1 billion worth of euros as collateral to ensure they get paid back.
Precisely. Then the European Central Bank takes those freshly minted US dollars and acts as a distributor, lending them out to the desperate commercial banks within its own European jurisdiction.
Mm.
The European banks get the dollar liquidity they need to survive the week. The panic subsides, the system doesn't collapse.
And when the dust settles?
A few months later, when the crisis has passed, the swap is reversed. The dollars flow back to the Fed, the euros flow back to the ECB, and the Fed destroys the digital dollars they created.
It is an incredible piece of financial engineering that prevents a cascade of global bankruptcies. But here is the profound irony that we absolutely have to emphasize. The very same countries that spend years actively trying to build alternative financial systems, the ones writing grand white papers about the necessity of reducing dollar dependence and securing monetary sovereignty.
The exact second a true crisis hits, they absolutely depend on those exact dollar swap lines. Or, at the very least, they rely on the stabilizing effect of the Fed pumping dollar liquidity into the global market to prevent their own domestic economies from collapsing.
It is the ultimate paradox of our current era. Nations crave monetary independence during the calm of peacetime, but the US dollar remains the indispensable, irreplaceable backstop during the chaos of financial wartime.
It proves unequivocally that the underlying stability of the entire global financial system still fundamentally relies on the availability of dollar funding.
And this endless tug-of-war between peacetime diversification and crisis-time panic leads to wild, aggressive dynamics in the foreign exchange, or FX markets, because these massive tectonic global forces are constantly pushing and pulling on currency valuations. Let's break down this cycle. How do these shifting liquidity dynamics actually play out on the FX battlefield every day?
It essentially operates like a massive global seesaw, driven primarily by investor sentiment and risk appetite. As we just outlined, uncertainty, fear, and crisis drive capital aggressively into the dollar. When the world is scared of a recession or a war, investors buy treasuries. This massive coordinated inflow of global capital naturally strengthens the value of the dollar relative to almost every other currency on Earth.
So fear equals a strong dollar. The dollar smile theory in action. And what happens on the other side of the seesaw when the sky is clear?
When the immediate crisis passes, central banks typically lower interest rates to stimulate economic recovery. Global liquidity expands. Money becomes cheap again. Investors feel confident and greedy. So what do? They take their capital out of those safe, boring, low-yielding U.S. treasuries, and they send it back out into the global economy looking for higher returns.
They start investing in emerging market tech companies, funding infrastructure projects in Asia, buying high-yield bonds.
Exactly. They move all the way back out onto the risk curve to chase yield. And to execute those investments, they have to sell their U.S. dollars and purchase the local foreign currencies. This massive outward flow of capital naturally weakens the dollar's relative value. It's a recurring historical cycle. A risk-off environment strengthens the dollar, and a risk-on environment weakens it.
But the geopolitical fragmentation we discussed earlier is throwing a massive heavy wrench into this traditionally clean cyclical seesaw. We are entering a chaotic era of diverging monetary policies.
This is a crucial distinction for the next decade. During the peak hyper-globalized era, major central banks often moved their interest rates somewhat in tandem. The global economy was so synced up that when one region slowed down, others usually felt it similarly. But today, because of the fracturing of supply chains and geopolitical alliances, nations are prioritizing very different, often conflicting domestic goals.
Give us a concrete example of how those central bank priorities clash in real time.
Well, look at the landscape recently. You might have one major region, like the US or Europe, facing severe sticky inflation and needing to aggressively hike interest rates to crush price increases and achieve local stability. But simultaneously, a neighboring region, perhaps in Asia, might be facing a severe real estate crisis and an economic slowdown, meaning their central bank desperately needs to cut interest rates to stimulate growth.
And a third country, heavily reliant on exporting cheap goods, might intentionally intervene in the markets to keep their own currency artificially weak, so their manufacturing exports remain globally competitive.
So instead of everyone in the boat paddling in the same direction to keep the global economy stable, you have major central banks pulling massive monetary levers in completely opposite directions, based entirely on their own domestic political survival rather than global coordination.
Which inevitably leads to wild, unpredictable, new volatility regimes in the currency markets. The old, reliable economic forecasting models don't work as cleanly when raw geopolitical priorities and domestic survival override pure economic data.
And as anyone in finance knows, whenever there is intense volatility, there is massive opportunity.
We have to talk about how the big money plays this game. How are the massive institutional investors, the multi-billion-dollar hedge funds, the sovereign wealth funds, the algorithmic trading desks exploiting these shifting structural dynamics?
The smartest players in the room understand that massive currency movements today frequently reflect sudden shifts in global liquidity incentives rather than just reflecting a country's underlying domestic economic health. They aren't just reading a country's quarterly GDP growth report, they are intensely monitoring the hidden plumbing.
They're watching the euro dollars.
They are tracking the flow of euro dollars. They are anticipating the exact moment when the Fed might tighten policy, knowing that the whale will drain liquidity globally and likely force a massive, violent dollar rally that crushes emerging markets.
They aren't just trading the news, they are trading the architecture itself.
Exactly. It involves highly coordinated strategic trading campaigns operating across multiple asset classes, bonds, currencies, commodities simultaneously. And what makes it even more volatile today is that geopolitical narratives act as powerful amplifiers for these campaigns.
Give me an example of that amplification.
A single headline about a new tariff on electric vehicles or a rumor about a potential new financial sanction can instantly shift global investor expectations. This triggers massive algorithmic capital flows that often become self-fulfilling prophecies, moving markets before the actual event even happens.
It is a high-stakes, ruthless game of three-dimensional chess, and the board itself is constantly tilting beneath the pieces.
It really is.
So, we have explored the Bretton Woods origin story, the explosive growth of the phantom eurodollar network, the undeniable rise of geopolitical fragmentation, the absolute illusion of immediate replacement due to the trifecta requirements, and the extreme volatility of the crisis panic room. Now, pulling all these threads together points us toward a very specific future. We are unequivocally heading toward a hybrid, multipolar financial system.
The overarching thesis to take away from all of this is adaptation. The US dollar is not collapsing. It is actively adapting to a more hostile, fractured environment. Its fundamental role is evolving.
Let's synthesize this evolution. For the past several decades, the dollar was the overwhelmingly dominant, essentially exclusive currency for serious global transactions. It was the only viable game in town. What exactly does the new paradigm look like?
The new paradigm is best described as adaptive dominance. The dollar is slowly transitioning from being the absolute, unquestioned monopoly to becoming the core anchor within a much broader, messier network of overlapping regional systems. It will remain at the dead center of the architecture, but it will be surrounded by a growing constellation of workarounds and alternatives.
It is like shifting from a solar system where there's only one giant blinding sun and a few tiny irrelevant planets to a galaxy with multiple star systems. The original sun is still by far the biggest and brightest object holding the core together, but there are other smaller sources of gravity pulling on trade now.
That is a perfect visualization. We are going to see these parallel architectures become permanently established features of the landscape. We talked about those regional development banks funding infrastructure without the World Bank, the bilateral currency arrangements bypassing SWIFT, the new digital payment networks.
Those alternative systems aren't just going to fail and disappear because they're inefficient.
No, they are politically mandated to survive. They will continue to grow and iterate. But, and this is the vital distinction that the doommongers miss, they will grow alongside the traditional dollar channels, not in place of them. We are moving toward a state of uneasy coexistence. The system is becoming multipolar. Regional currencies will handle a much larger share of the local trade and financial transactions within their specific geographic and political blocks.
So we'll see situations where China and Russia, or Brazil and India, might settle their localized energy and agriculture trade in their own local currencies, deliberately bypassing the dollar for those specific, ring-fenced bilateral relationships.
Exactly. This slow structural shift will gradually reduce the dollar's relative percentage share of overall global activity. If you look at the pie charts of global reserves in 10 years, the dollar slice will likely be smaller. But reducing its relative share of trade invoicing does absolutely nothing to eliminate its central structural position as the world's ultimate safe asset in the treasury market and the indispensable liquidity backstop during a crisis. It is a shift from absolute exclusivity to adaptive dominance.
Let's bring this all the way home. Let's talk directly to you, the listener, because understanding the macroeconomic plumbing is great, But what does living in a messy, fragmented, multipolar financial system actually mean for your daily life over the next decade? This isn't just an intellectual exercise for central bankers in Geneva. This directly impacts your wallet, your savings, and your cost of living.
It impacts absolutely everything. First, let's look at how you manage investments. The easy era of assuming that a rising tide of global dollar liquidity will magically lift all financial boats equally is over. In a fragmented, multipolar world, capital flows will be incredibly choppy and selective.
Meaning?
You will see massive divergence between emerging markets. An emerging market aligned with the U.S. trading bloc might thrive, while one aligned with a sanction bloc might starve for capital. How global risk is priced into your 401k or your stock portfolio will have to deeply account for these new geopolitical fault lines.
It means true diversification in your portfolio has to mean a lot more than just buying a mix of different tech stocks and consumer goods. It might mean deeply understanding which geographic regions are actively building resilience against dollar liquidity shocks and which are dangerously exposed.
Precisely.
And what about the everyday cost of living, the cost of the imported goods we rely on?
This is where the physical friction of a multipolar system hits the consumer directly at the checkout counter. We discussed earlier how the universal acceptance of the dollar smoothed out supply chains. It made global trade incredibly frictionless, efficient, and therefore very cheap. It gave us an era of cheap flat-screen TVs and inexpensive clothing.
But as parallel financial architectures develop and supply chains fracture into regional blocks driven by friendshoring, tariffs, and the desire to avoid sanctions, all of that beautiful efficiency is violently lost.
And in economics, inefficiency translates directly to higher costs. Always. Building redundant, politically safe supply chains instead of economically optimal ones is expensive. Hedging against sudden geopolitical risks and new tariffs requires expensive insurance. All of that friction adds massive overhead costs to the production of goods.
And that cost is ultimately inevitably passed down to the consumer in the form of higher prices for imported electronics, cars, and raw materials.
Yes. Living in a fragmented, multipolar financial world is inherently, structurally more inflationary than living in the seamlessly integrated world of the past 20 years.
So understanding this invisible financial architecture is no longer optional. It is basically a requirement for understanding the next decade of structural inflation, investment strategy, and global stability.
It absolutely is.
Let's summarize the massive journey we have taken today. We started by exploring the Bretton Woods Foundation and decoded the counterintuitive explosion of global liquidity that occurred after the gold standard was severed. We mapped the three unshakable pillars of dollar dominance: the $26 trillion treasury market, commodity pricing, and global banking. We illuminated the phantom eurodollar network that actually finances the world's trade in the shadows.
And we examined the very real accelerating geopolitical pushback against the weaponization of finance, acknowledging that the hyper-globalized system is undeniably fracturing. But we also confronted the immense practical structural barriers, the desperate need for a deep liquid market, absolute legal certainty, and open capital accounts that make rapid de-dollarization a mathematical illusion.
And we saw how, paradoxically, global panics reinforce the dollar's role as the indispensable backstop, even as the world transitions into a complex, messy, multipolar hybrid system. The global financial system is absolutely fracturing into regional blocks, but the dollar's deep structural advantages ensure it remains the foundation for the foreseeable future.
The overarching architecture is visibly shifting, but the foundational cornerstone remains firmly in place.
Now, before we go, I want to leave you with a final provocative thought. Something to mull over that builds on everything we have discussed today about networks and liquidity. We have talked extensively about the fragmentation into regional financial blocks and the dollar acting as the hybrid anchor in the center. But what happens to this entire structure when we introduce programmable money into the exact same architecture?
Oh, that changes the game entirely.
Think about it. We are currently seeing the rapid development and testing of sovereign central bank digital currencies, or CBDCs, alongside highly sophisticated decentralized digital assets and stablecoins. If the world is already highly motivated to build parallel payment rails to bypass SWIFT, what happens when a massive regional bloc launches a fully functional, interoperable digital currency that seamlessly settles cross-border trade instantaneously on a blockchain, bypassing the traditional correspondent banking system entirely?
It's a profound question.
Will this new technology provide the exact frictionless tools needed to finally break the network effects that keep the dollar dominant, thereby accelerating the fragmentation? Or will the U.S. simply digitize the dollar, leverage its existing massive liquidity, and accidentally create an entirely new, invisible digital reserve currency that simply replaces the old 20th century plumbing while maintaining the exact same dominant dynamics for the next 100 years?
It is the ultimate technological wildcard. Programmable money could either permanently entrench the current system by making the dollar infinitely more efficient to move globally, or it could provide the exact crowbar needed to dismantle it. It is the next great frontier of this invisible architecture.
It is definitely something to watch very closely as the decade unfolds. Thank you for joining us on this deep dive. The forces shaping our macroeconomic world are complex, and they operate entirely behind the scenes, but they are not impossible to understand once you know where to look and how the plumbing works. Keep questioning the invisible forces shaping your world, and we will see you next time.